My name is Josh Hoffman. I'm the asset manager for Lone Star Capital. Rob Beardsley, principal, is on the call as well. And so today we're going to have a review of our portfolio for the first quarter of 2022. It's been an exciting quarter, a lot going on. Movements on both the acquisition and disposition side, Capex, really a lot of action, and we're super excited. I think Rob will try to monitor the chat window if anybody has questions, and if I can see them, try and take a break to answer those questions if there's anything pressing. Otherwise, we should have some time for questions at the end. So here we go. Everybody can see my screen, yes? Take it as yes. So a quick review of the first quarter. We acquired Park at Champion Forest. This was mid-February. It's a later vintage than we've bought in the past. Super excited about it. 232 units in North Houston. The property itself is already in great shape. A number of the units were partially renovated, and we're going to essentially come in, renovate those, blow them out. Granite stainless is the plan so far. And then also renovate the classic units to bring them up to a higher level, and then increase rents with market rate and add some additional amenities as well. Broadstone Forest, I know this is the Q1 review, but including it here, we just closed at the start of the month. And so we're super excited about that as well. It's going to be ramping up the Capex plan very shortly. And that's at the forefront of our attention. On the disposition side, we sold our second property. It's our second full cycle deal, Verandas at Bear Creek, which is in North Houston. Netted investors about 30.4%. This is just from the sale proceeds and refunds that we've received so far. It might go up slightly, again, very slightly, after all refunds have come in for utilities, insurance, taxes, etc. There's about a 2.8-year hold period, closed on the 27th, so very recently, and equity multiple about 1.96. So super excited about this. There'll be a case study coming out very shortly that Rob and team has put together once we have all finalized numbers. So be on the lookout for that. Also, in terms of our headcount or employees, we brought on two amazing new members. First is Dasha Beardsley, who's heading up our investor relations team. Some of you might have interacted with her. If you haven't yet, I'm sure you will soon. And then Adel Kagan, who's leading our operations team to help really drive efficiency, synergies within our units. And yeah, it's going well so far. Capex review, we've had a lot going on. You can see here we're almost done with the landing. We're 99% done. There are 3 additional small projects that we're working on that were not part of the original budget. More so just issues that came up with having a 1970s vintage. So technically we are complete with our business plan and our Capex package, but we're showing 99% here just because we do have those few outstanding items. Solano's really underway. Pretty much most of the exterior work is scheduled and or completed already. And then in terms of our interior renovations, first floor units were, when we purchased the property, they were already in great shape and renovated. We're renovating all second floor units, adding washer and dryers. But as far as the amenities at the property, those are pretty much all completed. And so far, even without the additional renovations being completed yet, we're getting about $40 increases on renewals. We're also charging back, so it's not included in rent, but we're charging back about $45 in terms of RUBS as well. And then new units that we're leasing out are all at market. We bumped up market rate as well, and think we can push it even farther. I mean, I don't know what anyone else has seen, but speaking with other syndicators, other owner operators, Houston, Texas, I mean, Sunbelt, but Houston especially, the rents are high. I mean, they've increased quite a bit, and they're being gobbled up. So specifically with Solano, Encore, Park, Hollister, really all these properties, we think that we can push even further. When we get into occupancy, we'll see. But Hollister is essentially at 100% occupancy, and we don't want to keep it that high. I mean, we'd like to have a little room there. But even with those increases, these units are being leased right away. Hollister, we closed in November, and this plan is rolling along as well. The majority of the exterior work is done, similar to Solano. And in terms of our interior plan, there isn't a ton of interior renovations that we're doing. The property was in good shape. It was rebuilt after Hurricane Harvey, I believe it was. But we are adding washer dryers, and we are installing a smart tech package, smart locks, and that is slated to begin rolling out very shortly. We've approved the vendor, we've scheduled it, and looking forward to getting that going as well. That'll be not a very lengthy process of installation, but due to the supply chain, which we'll talk about shortly, supplies are backed up, and the actual getting the locks, the hardware, is the limiting factor in that plan. Encore and Park both were recently started. Encore was acquired in December, and then Park, as I mentioned, in February. But these are well underway. We're starting to renovate units at turn. We've also renovated a few partials. With Encore and Park, two constraints that we're having are, again, supplies on granite and then appliances. So we're looking to do stainless throughout, and supplies are backed up. I think there's, it's not an issue specific to us. I think pretty much everyone is facing the issue, and certain items are coming in. Certain operators are looking to overseas, but then you have to factor in the shipping cost. And if you're, let's say, ordering vinyl planking where you can spread out the 40K or whatever the tax might be, if you can spread that out over a number of units, it's a lot different than ordering slabs of granite, let's say from the Philippines or China or somewhere where you don't have to pay the tariffs. But if you're ordering that where there's a weight limit and weight constraint, you can only get in X number of slabs of granite, then it might not be as feasible. And so we're looking for different vendors, we're looking for different avenues, but essentially we're keeping the business plan the same and just looking to make do, and we'll make it do. Don't want to sound like it's dire consequence, but just a symptom of the market currently. And lastly, just to point out, so Hollister, Encore, Park, just full disclosure, it looks like we have huge savings. This is true at the moment, but this is representative of just what's been completed to date. So, I don't anticipate us having 73% surplus cash left over after we fully implemented the business plan here at Park Champion. Those numbers will come down as we run through our interior plan as well. So jumping into our financials here, by and large, we've seen, which I'm sure others have seen as well, utility costs being higher, insurance, taxes. And so one way we're trying to get around this, or particularly with utilities, try to manage it. Water is always a huge cost. And so water conservation plans are pretty much essential. So it's something that we're trying to do at all our properties to reduce that. And then in terms of not the landing, we're not doing smart tech there, but at our other properties, one of the benefits of having smart thermostats is that the on-site staff can regulate the temperature in vacant units and electric. So hoping that will decrease our further utility costs. But if we look to performance, let me just move this out of the way. So Encore just started. This looks very drastic. Looks like NOI is going down, which is obviously a bad sign. However, this is a lot of noise from acquisition, which we always see at the start of a project. So nothing to worry about there. It will hopefully level itself off. If we look to one of our longer held assets, again, you see huge discrepancies at acquisition, but then stabilizes as we move further along in the process. And so at Solano, our NOI still beating our budget. We've had some issues here, but they were expected in terms of turning the tenant base and some evictions as well. But that's a symptom that we were getting. We weren't under any preconceived notions that we weren't going to have to do that. If we move forward, just to elaborate on that, so Solano, looking at the historical collections, it seems to be, looks hugely cyclical. It looks like the start of the quarter, very low, and then it gets higher. However, it corresponds with the occupancy. Go to occupancy. And if I'm going too fast or jumping around here, feel free to stop me at any point. So taking out all that noise on the bottom, occupancy hovered around 92, 93%. There was some drop off after we acquired the property. And then in March, we started filing some evictions around December, January. Evictions started following through. Tenant base started to turn. And now, in addition to occupancy really rebounding, you can see that we've occupied the property with higher quality tenants, and our collections jumped up quite a bit. And this is also, it's not purely a symptom of higher quality tenants. There are also some rent relief funds that came in as well. But it is part of the picture that having higher quality tenants that pay the rent on time, this should stabilize over time as well. And if you look to Hollister, where we have a nearly fully occupied property with a well-qualified tenant base, the property itself is quite stable. This slight discrepancy here, which I mentioned on our last call, is just due to the shorter collection period. There's actually only 25 days, being that we're starting from January and our monthly collections end on the 25th. But otherwise, the property is quite stable. And in doing my review of the dashboard, and one of the reasons when we get to the end, I'll mention the API key, but I had tried to fix this. I didn't have a chance to fix it. But so this delinquency, just so you know, is not corresponding to individual properties. Otherwise, this would be a huge issue. If we had $115,000 in delinquency at any of these properties, there would be nobody's paying their rent, basically. But this is not the case. It's just, I think there's a slight fix tweak to make that the slicer is hitting this graphic in particular. But this is representative across our entire portfolio. As you can see, it's 115K here. And if we go to Hollister, it's the exact same thing. It's lumping in all of our properties. So by and large, we could look at, and we do track this in our weekly Capex and asset management calls. We track delinquency at all these buckets. And so looking at against our entire portfolio, it's has gone up a little bit here, but in terms of most of our properties, not something to worry about. And the other properties, we are managing this. If evictions need to happen, we'll take that action. We've tried to be extremely helpful and assist all tenants with rent relief if they need it. But just wanted to point that out in case anybody's noticing, you have huge problems at your property. That's not the case. There's just a back end fix that needs to be done. Okay, so in terms of our other properties, the Landing, you can see here income has really started to take off, and that's just a result of the property occupancy increasing, and similar to Solano, having a well-qualified tenant base. So we've turned the tenant base quite a bit. On new leases, we're getting premiums. On renewals, we're getting about $45 at the property. And yeah, it took a minute, and our investors were patient and stuck with us to see through the value add business plan, and they trusted us. And now the fruits of our labor is coming to fruition. And so it's great to see that the plan that we implemented and originated is actually working. For collections, one thing that I did notice for Hollister, we're basically an average of our prior monthly collection period. So we would obviously like to have all rent collected on the first 5 days, slightly behind where we were in March. March was a strong month. I'm not sure why April dipped, but it's rebounded since then. But still, we'd like to push that forward. And on our new properties, we're actually looking at a different online payment method, which we think might be a little more intuitive and user-friendly. And so that's one way that we can further increase the amount of collections that we receive within the first few days. Having a portal that people like and can go to and quickly and easily make their payment or put it on auto pay. Similar story at the Landing. March was an amazing month in terms of collections. Some of this was money owed to us. So again, if you average that out, still we're on the upswing in terms of collections. So looking at Encore, you can really see the property jumped hugely between March and April. And so that was about a 3% increase month over month. This issue right here looks like quite a big issue. However, if you read into the data, there's only 3 of these units. So currently 2 are occupied, then all 3. One of those tenants moved out. So we're still at 2 out of 3 units occupied. But otherwise, property itself is largely doing well, and we haven't renovated, maybe 10% of the units at this point. So we've got a lot of room to grow in terms of our rent increases. So looking at these 2 types of units, so this is a 2-bedroom, 1-bath, non-renovated. R is renovated or was previously renovated, but they're partial. There's still some meat on the bone left for us. And so as we've started to renovate these, we're able to garner quite a bit of upside. Similar with the renovated units that we're taking to a full premium. On the conversely, so the non-renovated units are getting over the last month, about a 0.83% increase. But if we look to the ENC B1R, so this is a 2-bedroom, 2-bath, partially renovated unit. There's still a lot of room that we can bump these rents as we renovate these. And so this unit mix is going to essentially turn into all the R units as we go through our business plan. And so this unit mix will change. And with that, the rent of the property is going to significantly increase as well, which would be great for our cash flow. And then, so here you can see we've increased the market rent in terms of our budget, and now we're pushing rents as well on renewals and new leases. At Encore, we have been implementing $50 renewals increases, and had no issue with those, even with these units not being renovated. And so we've pushed it up to $60, and still renewals are going through quite smoothly. And as we further get through our business plan, we're very optimistic that we'll be able to further get these rents per square foot up over market rent. And at this property in particular, as of last month, on the several units that we have fully renovated, or partially renovated, we haven't installed granite yet, but those are already getting $100 premiums. So as we fully install granite and stainless throughout the property, we believe that we can push that even higher up above our pro forma. Let's see. So this is quite a bit of noise. There's just a ton of unit types at Hollister. It's an interesting property. It's basically, I don't know if anybody's looked at it, but broken into two segments. And so on one side, it's mostly brick, 2 stories, typical garden style apartments. And then on the other side, which is across a small little road and slight wooded area, there is a mix of almost like townhouses and 3-story buildings. And so there's just a ton of different units here, but we track all of them separately and individually. And here, as you can see, so this is looking at only occupied units. And so as more units come online, or pardon me, as we increase the rents of those units, which we're able to do, this will increase as well. But as I mentioned, the property here is 98% as of April, and I believe as of a week ago, it hit 100, but there are several notices to vacates. So looking at our leasing data, so this is Encore. If we go to our two first properties here, as I said, VBC and sold it, as did Cranbrook. But yeah, here we're largely getting the benefit of online advertising, but also some drive-by activity. April dipped slightly, but one thing that we're very excited about is that we've enhanced the curb appeal quite a bit, and we have one of those last remaining projects to complete is a updated soccer pitch on a basically derelict basketball court. That's 75% done. The playground that we installed is finished, and that will further increase the attractiveness of the property. And if you look, move this bar out of the way. Okay, so I think it's this bar here, but referrals. We're always looking at referrals. How well are we doing? Nobody's going to refer somebody to a property if they're not already happy living there. And so referrals are staying pretty consistent. If we look to Solano, so this is a very positive and great trend that we're happy to see. The leads that we're getting, the attention is really going up, getting much stronger, which is amazing. We're also having consistently this year, many more showings, applications are up. So, and then our leases from applications, 100%. So basically, we're being, as of April, we were able to get very well qualified tenants. Anybody that's applying was getting approved, whereas in prior months, you know, some people that had applied might have been denied for one reason or another. This looks like a bad trend, but we'll have to wait till March to see. One of the explanations for this is the property itself, the occupancy is quite high already. So you can see it went from 94.4. We're currently at, or as of last month, the 25th, 97%. So if people are calling or inquiring and the property is, there's not many units left, or maybe they're looking for a 2-bedroom and we don't have any, or they're looking for a 1-bedroom, whatever it may be. That's one explanation that we've seen and that we're following up on as well. But definitely want to keep pushing that and keeping the interest up. And as notice to vacates come and we renovate units that are currently vacant, then we need to fill those units as well. But here you can also see that in terms of our renewals, I mean, people are staying at the property. They're generally happy with the new change of ownership, new change of management, and looking to do what we can to really increase resident satisfaction and retention. And so at this property in particular, we've had a number of on-site activities for tenants, and then I don't know if you want to call them activities, but just functions. So a number of food trucks, basically one a week, we'll have different food trucks come stop by. Another example is for Earth Day. A few weeks ago, we gave out plants to all residents for their patios. They have nice patios and balconies. Essential oil making class. Just a variety of different activities, social events for our tenants to take advantage of. Some there are fees, some there aren't. It's more so, and not looking to make this some huge other income item or some huge revenue driver, but more so increasing or keeping our occupancy up. And then at renewal, being able to increase the leases and the rents there. So it's it doesn't take a ton, and it's honestly it's more about just showing some thought and some attention, and it pays off greatly in the long run. One thing, so I was at a conference recently, and I was talking with Adel, who I mentioned earlier. We sat in on a panel on having centralized leasing offices. And so one thing that we both thought quite interesting was that this person who was speaking, who's an owner operator, was saying that they're seeing, by using a centralized leasing office, they're seeing decreased costs on rent leases of about $5 to $10 per unit, which certainly adds up if you have a portfolio like ours or larger. We're currently at about 2,000 units. It makes a huge difference. And so one of the underlying reasons that was given for that was typically in the typical real estate model, somebody that's in multifamily leasing, the career progression is to move into management. So to become a property manager, you've already got a grips on, I guess, the amenities at the property and the units and a feel for the property, and you move into that natural role. However, if you can find somebody that's just a natural salesman or salesperson, then you can use them and leverage their talent and keep them happy if that's what they want to keep doing, and really use that skill set in terms of somebody that's just doing this temporarily as a stepping stone to the next position. And so, I mean, most of the people that I know that are in commercial real estate, that's, they're making great money. That's where they stay a lot of times. Maybe they go do something else. But I know a lot of brokers that do that for life. And so this is one thing that we are looking into potentially doing, is centralizing our leasing now that our operations are expanding, and it might make sense for our portfolio. Moving forward, if nobody has any questions there, I can certainly go back if anybody does. But so looking forward to Q2, I know we're at this point already halfway through it. I can't believe it's almost June here, but we will be starting, we've already started our Capex at Broadstone. So approving vendors, looking at scopes, revising our scopes, as I mentioned with the supply chain, looking at different suppliers for granite, stainless appliances. Another interesting factoid that I heard over the week, prior week, was that some particular operator was trying to install black appliances. And he had told this particular person that was speaking on the panel that he's waiting for a bunch of appliances from GE. And so her response was, well, you know that since 2021, GE has made no black either stoves, ranges, or refrigerators. So they basically, I guess there wasn't that much demand, and then COVID hit, and they've essentially stopped producing those. So I'm not sure that he was aware of that, but just different things to be in the know of, and always the reason to have backup vendors, and if possible to buy in bulk. I mean, it might not always be possible, but to buy, let's say, a ton of vinyl flooring, and then keep it on site to turn units quickly and easily. But so it's a long-winded way of saying we will be kicking off Broadstone Briar Forest Capex. We do have 2 properties under contract currently, so I've listed them there. Timberwalk, it's about 300 units, typical vintage that we've acquired in the past, 80s, and this is targeted for a June end of month close. That's going to be an amazing addition to our portfolio. And 5 Oaks is on the north side of Houston, in an area close to some of our other properties. That's 228 units. It's a newer vintage, the newest vintage we've acquired to date, or will acquire, and that's slated for a July close. So both of those are underway in terms of all of our due diligence and processes, and can't wait to share great news, hopefully next quarter, when both of these are in our portfolio. And lastly, on the tech side, spent some time with our property management software provider to get API keys set up that we can connect to, that will really unleash power for this dashboard and make it just next level, and allow us to really garner all of our data real time and kind of blow this dashboard out, which we're very excited for. We use it. We use all their data. They create some reports for us, but this way we'll have a really amazing finger on the pulse, and just shorten any delay periods that we have between reporting and what strategy, what tactics should we implement. So really looking forward to that. The issue, not to throw them under the bus, but the issue hasn't been so much that we're dragging our feet, but there's quite a bit that needs to be done on the back end, and so they're working with us and should be underway shortly. And so we're super excited about that there as well. They've really been accommodating, and there's some stuff to do for them. So very much praise to them. Resman, by the way, I guess I should mention. And that's all I had. I didn't want to speak too long. I don't know if anyone has questions, comments, constructive criticism. Take all of it, or none of it if have other things to do. I'm sure everybody's busy before the weekend.
Yeah, Josh, thanks for that. Very nice job. And thanks everyone for being on as well. Looks like we just had one question come in earlier that I answered directly, which was about the dashboard itself. We get this question every time we have this webinar. People are curious to know what software it is and how it works. So Josh, you want to just kind of share that?
Absolutely. So the visualizations here are all created in Power BI, which is a Microsoft product. The data is all coming from Resman, which I just mentioned, their property management software. So currently we're having to export raw data, run it through the ETL process, extract, transform, load. And then once it's in Power BI, then we're able to manipulate it and chop it up and visualize what we want to see. But the goal, as I just mentioned with the API key, is to essentially have a direct link to their database and their platform, which will feed Power BI. So there'll be less manual input, less, I guess, tweaking and such, like that one particular delinquency note that I made. So it'll just be much more automated more intuitive. And with that, we'll be able to visualize a lot more data, get more granular, and yeah, just have a much better and quicker idea of our data and how to react to it or act on it. But yeah, it's Power BI, views Tableau, that's great as well. But we like Microsoft products and just wanted to keep the suite in-house.
Absolutely. Next question is from Donnie about interest rates and what we're doing to adjust in the volatile market. So the biggest thing that we're doing is lowering leverage. Before all this interest rate volatility and rate hikes coming from the Fed, we were borrowing typically 80% loan to cost bridge loans, which were widely available in the market and were priced really competitively. There was a lot of lenders in the space that were competing against each other, bringing the cost down of those loans. Today, you are seeing a lot of lenders pull back on their loan terms and requirements and underwriting, and some are even just taking a pause completely as they wait out the volatility. So what we've done is, by lowering leverage, it opens ourselves up to a broader pool of lenders, which of course now with a broader pool, we're able to go out and select the right lender for us that has the best terms available. And what we're finding is pricing at lower rates it makes a lot of sense, where, like I said before, you could go up in leverage and it really didn't cost you that much more. Your spread, your interest rate was very low already. But now we're seeing, by going down in leverage, you are getting a pretty good savings in rate, and it's worthwhile to do that, as of course we're pursuing risk-adjusted returns, not just maximum returns at any cost. So number one thing is really just lowering leverage, which again gets us the best terms that we see in the market, and number two, just reduces risk for the deal all in all. So that makes us feel a lot more comfortable about any unforeseen circumstances that might come up. I mean, we think our portfolio is going to do fine, but at a lower leverage, you just are that much more protected.